Hello and welcome to this video. Today I'm going to explain the statement of changes from the book Buying and Working from LWEO for suitable free-level bilingual pupils, and it is dealt with in chapter 5. In another video I told you about the balance sheet and what a balance sheet is and how it works. A balance sheet is always in a certain moment in time. So you can imagine that throughout the course of time, the balance sheet changes. Yes? And it changes because of so-called financial events. So a financial event means that something happens which causes the balance sheet to change. Normally, it's only a few items on the balance sheet that change. So it would be a bit silly to every time that a financial event takes place to drop a fully new balance sheet. So what we do is we only fill in the changes in the so-called statement of changes. A statement of changes is actually a bit of a mini balance sheet in which we only show the item that has changed and by what amount it has changed. In this video, I'm not going to talk about the amounts because the amount is different from event to event, but I'm only going to show you whether the amount is increasing or decreasing. So if the amount is positive or negative. The amount is normally given in the assignment which you are dealt with. Yes? So I've come up with 8 sort of standard financial event that normally take place, and I'm going to guide you through how the statement of changes work. First, I'm going to give you an example of purchases. So suppose that you want to buy a stock of clothes, for example, like Sarah in the book, and you buy them, which means that your stock of clothes will go up. So your stock goes up. So what happens if you buy things, your purchases, your stock goes up. So it's a positive amount. Well, there's 2 things that can happen. Either the people that you buy your stock from say, I want to have the money straight away, which means that your liquid assets go down. I'm going to do this in red because there's multiple options. So either your liquid assets, so your bank or cash, goes down, or the people that have sent you these goods say, well, you're such a good partner, you can pay in 1 or 2 months. Yes? So then you have a debt, and the debt is called creditors. So creditors are people that you buy things from and you have to pay them later, not straight away. So the debt goes up, so your creditors go up. Again, in the assignment it is mentioned by what amount. Yes? Or a combination that, for example, half of the amount is paid directly and the other half has to be paid within a month. Yes? So there's multiple options here. If you have creditors, you're bound to pay them eventually. So if you do so, if you pay a creditor and you pay, that always means that your liquid assets go down. So paying means your liquid assets go down. So first things, liquid assets, they go down. If you paid your creditor, you don't owe them money anymore. Or at least you owe them less money. So that means that your creditors go down as well. So the amount of your debt goes down. So that's a negative amount. Alright, now something very special happens with sales, because sales involves a few things. You sell someone something, so that means that you have to give them something. So your stock will go down. Yes, and you have the cost of sales, so the purchase value of your sales. And another thing that happens is that you get money. Yes, because you sold someone something, you get money. You either get it straight away via the cash or the bank, or you get it later, and we call that debtors. I explained this in my video on the balance sheet. So, what happens? First things first, I have to give someone the goods. So, I'm going to focus on that first. So, if I give someone my goods, a part of my stock, it's no longer mine, and so my stock goes down, because in the balance sheet I show what is mine and what it's worth at the time. So my stock goes down. If I sell someone something, you learned in chapter 4 that I have turnover. And if I have turnover, I have cost of sales as well. And cost of sales is the price that I paid for the things that I sold. The cost of sales makes my owner's equity go down. So, stock goes down, as does my owner's equity. And it goes down by the cost of sales. Yes, so that's the delivery of the goods. Now, receiving the money. The money that I receive is the turnover. So, I either get it straight away, which means my liquid assets go up, or I get it later, which means that I have debtors. I explained this in my video on the balance sheet as well. So either my liquid assets go up or my debtors, they go up. They go up by the amount of the turnover. Yes? The turnover is in my results as well, so it influences my owner's equity positively. Yes, so my owner's equity goes up. And it goes up by the amount of the turnover. So, it goes up by the amount of the turnover, and it goes down by the amount of cost of sales. In chapter 4, you learned that turnover minus cost of sales, the purchase value, equals your gross profit. So, in the end, your turnover will increase by the amount of the gross profit. Yes? So this is what you do when you have sales. If you get your money later and you do receive it, then your debtors pay you what they owe you. So, what happens if your debtors pay? If someone pays you, that automatically means that your liquid assets go up. And if your debtors pay you, they don't owe you the money anymore. So the amount of the debtors go down because they owe you less money. Yes? In chapter 4, we learned all about the turnover, cost of sales, gross profit, and other operating costs, such as the energy bill, rent, interest, and so on. So, what happens if you pay other operating costs? Well, if you pay them, paying means your liquid assets go down. Actually, you pay something which you can't put on the balance sheet, because here you paid for stock which you could put on the balance sheet, so the balance sheet was in balance again. Now you pay for something which you can't put on the balance sheet. So your assets, they go down in value, nothing other happens. Your liabilities, they remain the same. So you've learned in chapter 5 through the assignment that your owner's equity equals your assets minus your debts, your liabilities. So what happens if you pay costs? Your owner's equity goes down. Because in a way, you get poorer because you pay something which you don't get anything in return for, which you can put on the balance sheet. So the money's gone. Yes? You had the rent of the building, maybe, so you had the building in which you could stay, but it's not yours, so you got poorer. Yes? And your wealth is expressed in the owner's equity. Okay. Fixed charges, told you, they are the belongings that are supposed to be longer in your company for more than a year, such as buildings, cars maybe. So if you buy a fixed asset, your fixed assets go up. And your liquid assets, they go down because you have to pay for it. Theoretically, you could also say that if you pay later, then your creditors go up. So I explained how this works here, and it works the same way here. So I'm not going to write it twice. Yes, so it could be creditors as well. So see how that works there. Yes? All right, so if I have a loan with the bank, so if I have liabilities, then I have to pay interest as well. Yeah, depreciation first. My excuses. So if I buy fixed assets, they lose their value. You can imagine if I buy a car for 50,000 euros, after a year, it's not worth 50,000 euros anymore. Yes? If the car loses value, fixed assets lose value, we call that depreciation, which is a part of the operating cost as well, but I'm going to deal with them separately. So, because what happens is your fixed assets they lose their value, so they go down in value. Yes? And because depreciation are costs, your owner's equity goes down as well. Because the things that you own lose their value, so you become poorer in a way. Yes? And your wealth is expressed in the owner's equity. Yes? We call this depreciation charges, which are a part of the operating cost as well. But as you can see, they are dealt with differently. Now, if I repay a loan, this is what happens. I have a loan with the bank and I repay it. So, if I pay something, my liquid assets go down and my loan goes down as well. Yes? So nothing happens to my owner's equity. If I pay a loan, I have less debts, but also I have less money, so I'm equally rich. Alright, so I'm going, normally when you have an assignment that concerns repayment, also the interest is paid simultaneously. So I'm going to tell you how this works. Suppose that you have a loan and you repay the loan 500 euros, plus you have to pay 100 euros interest. So this is what happens. So you have to pay an amount of 600 euros. So your liquid assets go down by 600 euros. So negative 600. Your loan goes down as well by an amount of 500 euros, so negative 500. Your interest goes down as well, owner's equity, so interest is owner's equity, negative 100. I don't write interest, I only write down the item on the balance sheet that changes, so you have to use the names which are in the balance sheet. Then, just like the balance sheet, you take the total and it should be in balance. So this is how you write down a statement of changes. Alright, so hopefully you've learned how statement of changes work. There are approximately 8 standard financial events, and with each event I told you how the balance sheet changes through these statement of changes. So hopefully you get it. If you don't get it, please don't hesitate to ask me questions, and hopefully I will see you again later. Don't forget to subscribe so that you know when other videos are uploaded. Cheers.